Okay, well, hello everyone, and welcome to our annual State of the Market panel discussion. I'm Savannah, the Director of Marketing here at the Cyber Insurance Academy and moderator of today's discussion. We've had immense interest in this webinar with almost 500 registrations, which is totally mind-blowing. So I know we may have a lot of audience members today who maybe aren't familiar with the Cyber Insurance Academy and what we do. In a total nutshell, we're a 24/7 online academy for all things cyber insurance and emerging risk. We have an accredited training program specifically designed for insurance professionals, and we also run a continuing education program for our community, of which this webinar is part. Some quick housekeeping before we begin. I'll be asking our amazing panel about their take on the cyber insurance industry throughout this webinar, and we will then open the floor to questions. Please submit the questions in the Q&A feature on this Zoom call. You'll find it just below. In today's panel, we have insurance professionals from across the cyber policy supply chain, and each with their own unique perspectives on today's market. We have Yosha DeLong, Global Head of Cyber at Mosaic, which was named by Advisen as Cyber Newcomer of the Year in 2022. We also have Neil Desai, Vice President of Cyber Practice at Lockton, the world's largest privately held insurance brokerage firm. Moving along the chain, we come to Anthony Hess, CEO of Aceris. If you've not listened to Anthony's podcast called Cybersecurity and Insurance Leaders, by the way, I highly recommend it. And last but not least, we have Judy Selby, partner at Kennedy's. Judy is a highly regarded legal advisor on cyber insurance claims and has been featured in prominent publications, including Wall Street, the Wall Street Journal, Law 360, and Fortune. Welcome, everyone, and thank you very much for your participation. Before we get into the nitty-gritty of today, I would love to go around the panel and get everyone's quick answers to this. Sum up cyber insurance in 2022 in 3 words. And I think, Yosha, we'll start with you and move our way down the cyber policy supply chain.
Yeah, thank you so much. Inconsistent, evolving, and progressing.
We'll go to Neil next.
Yeah, I would say it was harrowing, turbulent, and transformational.
Anthony?
Answer this slightly differently. I went with losses have stabilized. And then I had sort of a less serious answer in light of Coalition's announcement today, which is everyone's an insurer.
And finally, Judy.
Well, Yosha stole one of my words, but my words were crucial. I think the coverage is crucial. I agree that it's evolving, but at the same time, it's maturing a bit as well.
Okay, well, thank you very much for that quick fire, giving us some food for thought before we launch into the discussion, which I will come to now. So, Yosha, I want to start with you. We've seen some real hype around the growing issue of systemic risk recently. At the tail end of 2022, we had the CEO of Zurich claiming that cyber attacks were becoming uninsurable as disruption grows. And we then kicked off 2023 with the news of the first ever Beazley cyber cat bond. So I'd love to know from your perspective, how is cyber accumulation risk being considered by underwriters at the moment?
Yeah, and I think I'm going to try to keep this as short as possible because I think this could be in itself an hour-long conversation. There has been, and the recent head of a company saying that this may not be an insurable risk is not the first person to say that. This has been said for probably the last 7 or 8 years. There's been a lot of people that say we don't have the right data. We don't know what we're doing. We don't know how to price this. And I frankly disagree with almost all of those statements. I don't think that we have a lack of data. We have a lack of structured data. We have a lack of a common taxonomy. And a lot of those issues cause us to think that we don't have the right data. Or we don't have the data that we actually need to underwrite. And it's also a very different conversation when you take it from the point of view of a portfolio manager who's managing their own portfolio as a direct writer versus a reinsurer. And I also have to say, you know, a lot of times the perspective I have when I come in and I say, well, I know how to manage my portfolio and I know the right things to do to minimize the accumulation risk and I know the right tools to bring it in. Sometimes those aren't as transferable to our reinsurance partners. And I always have a lot of compassion and sympathy for what they go through when they're trying to compile all these different portfolios together, that we don't collect the same data and we don't use the same terminology when it comes to these things. So there's a huge challenge there as this goes up the supply chain. But just addressing it from my perspective as a portfolio manager, you know, I have had a strong belief for a long time that there are ways that we can manage accumulation risk. And it goes from all the way from your pre-underwriting process all the way through how you monitor your portfolio once it's a part, or accounts are a part of your portfolio. A lot of that's through the diversification of the risks, diversification of locations, diversification of industries, and just taking some of those minor steps, you're going to result in a decrease of over-reliance on any one service provider, technology service provider, supplier, vendor, any of those things. So that's something that I already think takes the steps in the right direction to manage that portfolio in that way. And then going back to really what the evolution that the insurance industry has been on over the past couple of years of starting to look at the controls that risks have and setting minimum controls. And this evolution really started, I would say, at the end of 2020, early 21, where we started to say, we actually have evidence, and we have evidence that is measurable evidence that some of these controls and having these certain controls in place can actually minimize the impact of an event. Some of these controls can help minimize the fact that you would even have an event. And then there's the controls that we look at that minimize the impact of the event and your downtime. And once we're starting to pull those things in and really start to look at that and layering that on top of a very robust portfolio management strategy, we can really look at reducing our accumulation risks. And I think from, you know, going back to kind of the reinsurer's perspective, if they have the confidence that the teams that they're reinsuring are managing their portfolios, that's going to give them confidence that the portfolios that they have under their purview are also going to be accurately measured, and the accumulation is going to be taken into account from day one. I think one thing we don't talk about in accumulation very often, which is just now becoming a topic point of conversation, and I know Judy has a lot of thoughts on this, is really around the regulatory aspect of privacy. We tend to think of accumulation in like a large scale, malware type of event, large scale ransomware type of event, but there's still the potential for us to have a large scale event that could be related to regulatory. And that's when I think the industry is still really grappling with how we start to look at that, how we properly underwrite that, how we insulate our portfolios from that type of exposure, be that, a metapixel type of event, be that a very aggressive regulator in the US going after, a lot of large scale companies. There could be lots of things that come into play there. And then I think really looking at the technology that we're using to monitor our portfolios after we put them into our portfolio, create our portfolio, and really looking at monitoring those risks, starting to look at patching cadences, starting to look at the way people have backups, and the evolution that we're looking at now into going into the inside out portfolio view as well, is really going to help us as underwriters create a more sustainable long-term product for the market.
We will get to Judy in a minute just to talk about the what you were saying about regulation previously and that kind of wide scale impact that can have. But just before we do, Anthony, I'm going to jump to your end of the cyber policy supply chain. I'd love to have your take on this from an incident response perspective. How do you think incident response could play a role in curbing systemic risk this year?
Yeah, I think it's a challenging question. There's a few points that I can think of there that probably apply. I think that the first one's a pretty simple one, and it applies pretty globally, but it's just that good incident response, which I define as fast, high quality, and accurate. In this case, it's if it's done well, it'll reduce the impact of a single incident. sort of scale that up, take it in aggregate, then it is going to reduce the overall sort of systemic risk. The faster you can get, systems back up and running, you're going to reduce your business interruption, which will really have a big impact, obviously, on the loss. I think there's some other things too. So looking at, let's say you have really good incident response and you have a single kind of SolarWinds supply chain breach type of incident. The faster you can get in there, the faster you can figure out what's been impacted, the faster you can kind of close off the vulnerability, sort of end the incident, the quicker and you're going to handle it, the less impact you're going to have, from overall kind of aggregate risk perspective. I think as well, another point that I like to make on this is, we spend a lot of time focusing on kind of actuarial product development, a lot of talk about war exclusions over in this part of the world, kind of underwriting actuarial product, there's a lot of talk about how you handle systemic risk, and I see it all the time. I think one thing that's less maybe discussed publicly is just, how are you thinking it through from the claims side? How are you really going to handle this when, when the big one comes? It isn't, I think it's somewhat easier to think through capacity, and that is probably where a lot of the insurers have started. Like, do I have enough capacity? If I have enough incident response vendors, enough, sort of people on panel, law firms, et cetera, to help out. One thing that I like to share with people, because when it was an experience of mine in terms of claims handling during NotPetya, you had NotPetya, it was interesting because it was spreading through the internet, right? Like much like the more traditional, internet worms we used to get all the time 20 years ago. It was out there, it was on the internet, it was spreading, from company to company, basically. And then within the company, especially, it was really spreading. And so you ended up in situations where if companies were contacted or were connected, excuse me, you could be in a situation where you have an incident response company on one, they're not able to take the other side of that because there's a potential for conflicts. I mean, at least not unless they've been really ready for it and can find a way to properly isolate it, et cetera. More likely what you're going to see is they're going to turn you down. They're going to say, look, we know we have this contracted capacity, we have the capacity, but we can't help that client, or we can't help that client because we think this other client they're connected to, may have spread it to them. So, I think that's something that needs to be planned for and kind of exercised, just like any other cyber incident. So yeah, those are kind of some thoughts I had just in terms of how good incident response plays a role. Maybe one other one I might toss in there is just, we've seen the last, I'll say 10 years, maybe it was before that, but I think I've been seeing it for the last 10 years. It's just a real professionalism of the industry, the growth of a incident response focused industry, in particular around insurance, but it exists more broadly as well. I think it's insurers, when they're writing in a lot of different markets, need to really be aware of the fact that they need to have the capability there. There may not be capability in every market. It may not be as developed. It may not be as professionalized as it is in some of the more developed cyber insurance markets. So that's kind of the last one. I think having good incident response in places where you may not have expected to need it is really useful.
Thanks. Neil, we have heard from Yosha and Anthony about, given some context of the changes that the cyber insurance industry has experienced over the past year or even more recently. We've had an idea of the changes, I guess, that we can expect, or the trends that we can expect in 2023. With this in mind, and given that you act as the middleman of the supply chain with visibility spanning across from the end client to the insurer, what do you think is the role of the broker in 2023, and how do you cope with this incredible amount of information on the proposal form, or needed from the proposal form, and how are clients dealing with this as well?
Yeah, I mean, I think it's a great question. We've definitely transitioned from where we were a year ago at this time. The first half of 2022, our job was really to provide bad news as gently as we possibly could. The majority of our clients and others that were procuring cyber insurance around the country were seeing, triple digit rate increases, coverage restrictions, ransomware co-insurance, ransomware sublimits, things that were not only causing increases in the price they were paying for the product, but also, conveying that your coverage was going to be substantially less impactful in the event you have a claim. We were also trying to manage in 2022, educating clients, both large and small, on the areas of their cybersecurity posture that would need to be improved in order to get a product that was actually going to be beneficial to them. And obviously that was substantially more challenging with the middle market and small business space, where there may not be budgets that were applicable to getting those controls in place, or an understanding internally from an IT staffing perspective as far as how to get those in place in a timely fashion. I think we definitely saw the risks out there become more resilient in 2022, and obviously that contributed to the stabilization that we started seeing in the marketplace towards the latter half of 2022 and now as we enter 2023. So I think currently kind of our job as a broker has become more geared towards managing expectations. There's a really, really wide discrepancy right now in what we're seeing between what a good risk is seeing in their insurance renewal versus what a risk that may have had a large claim, or it may still be lacking in the important areas like MFA, backup resiliency, EDR, what they're seeing both from a coverage and pricing perspective. So we're really just trying to kind of toe that line between making sure that the insurance markets that we trade with are comfortable with the risks that we're bringing to them, but also making sure that our clients are understanding kind of where the market is headed, what's being requested now, how there are different expectations when you go from market to market. I think we discussed this when we spoke the other day, but there are certain markets that are more interested in things like service accounts with domain admin privileges. There are others that are more interested in providing their own application for completion. Here at Lockton, we've tried to aggregate as much from the overall marketplace into one application as we possibly can, not only so that we can keep a better track of what each individual client is doing from a posture standpoint, but also so that we are getting the markets what they need from an information standpoint. But obviously it is a very, very key concern of ours to make sure that we're not over providing, that we're not kind of giving too much of an ask to our clients, and ensuring that what we are providing is going to be sufficient to get them the terms and the pricing that they need. So I think the job as a broker is definitely evolving continuously. It can change from quarter to quarter. We're only one widespread systemic event away from the market shifting back to where it was a year ago. And so we're really just trying to ensure that we're not over promising and under delivering, but that we are making our clients aware of kind of why the market is where it's at, which right now I think is in kind of an inflection point where there is a realization that maybe there was too wide of a swing a year ago. And now we're just trying to get back to a point where there's a little bit more of an equilibrium in the market so that our clients are, as well prepared as they possibly can be.
Thanks. Actually, I wanted to ask Judy next. I mean, we're hearing about this kind of frustration, I guess, on the broker side in terms of a communication gap along the supply chain. What's your take on this from a regulatory perspective? What role should regulators be playing to kind of bridge that gap without, of course, damaging the healthy competition that the market needs to actually grow?
Well, one of the big issues that I hear about all the time, and I know it makes Neil's life more difficult, is inconsistency or differences in policy language from insurer to insurer. I don't know what type of role regulators can really play in that space and trying to bring some standardization there, especially in the US. But on the broader point of whether standardization of policy language is a really good approach at this time, my thoughts are, I don't think we know that yet. We saw issues with LMA around the war exclusion, how difficult it is to get kind of standard language that will be acceptable to everybody and that will be enforced by various courts that will look at it. But also, I think, in the cyber context in particular, the policies are extremely complicated. They're probably the most complicated policies on the market, between the first party coverage, the regulatory coverage, the third party, and some tech E&O media thrown in as well. Those all create challenges because those are all very different types of coverages. But at the same time, there's also very different types of insureds out there. So if you're looking at, a highly regulated industry where maybe a large insured that has a large retention, and they're subject to regulations around cybersecurity and similar concerns, an insurance company may be more willing to let that insured take more control over how an event is managed, whereas an approach like that might not make as much sense with unsophisticated companies, where the insurance company is going to want to maintain that, the consent requirements before the insured, pays a ransom or incurs costs or hires vendors and law firms. And those things raise very, very important considerations in the underwriting process and how the policy will be priced, depending on who's really maintaining control over how an event is going to happen. And then when you look at the different insurers' approach to regulations that are out there as well, we see that some insurers limit their regulatory coverage to claims arising out of a data breach or a security event. On the other hand, some insurers are writing coverage for a violation of any privacy law anywhere in the world. And so very, very different types of coverage at issue there. Some might be better for some certain types of companies and certain industries, others not. And when you consider and I think this is what Yosha was referring to earlier, when you consider how you underwrite for this type of exposure, especially for regulatory actions that bring a lot of subjectivity to the table, such as a regulator looking at your privacy notice and saying, we don't really think that's clear, or that's a little confusing in some areas, or how well can an insured respond to data subject requests within the required amount of time? Things of that nature, extremely difficult to underwrite, hard to get a handle on what that exposure might be. We've seen proposed fines in this area where there's been no data breach, there's been no security event. It's all around like how disclosures are worded. Very, very high proposed fines in that area. And so these are things that I think each company has to really consider what their approach to it is going to be. Some other points is we're just seeing now for the first time in lots of areas where the policy wording is really being tested. We're going to talk about the claims dynamic later on, but how wordings play out in real life when real claims start coming in, that the claims are getting bigger in many ways, impacting lots of different insuring agreements in a policy. I think of business interruption, for example. How are we resolving quantum disputes on business interruption? How are we resolving issues around what's the right methodology that a forensic accountant should use? And then Yosha, I believe, mentioned like metapixel claims. We're seeing lots of metapixel data tracking, wiretapping type of things. And to further complicate the issue, in the United States at least, each court, each state will apply its own, rules of policy construction and interpretation. And a lot of the, fundamental principles, I should always say, the fundamental principles of insurance policy construction should apply to cyber policies just as they would to any other policy on the market. But having said that, how the particular wording of any cyber policy will play out in today's market is really unknown in some ways. And so it's really an evolving space. And to say that, we have like this one policy language, this one set of wordings that should be applicable across the board, I don't think we're anywhere close to that. at this point. And then I know Neil and Yosha alluded to the issues with standardization, perhaps of some underwriting inquiries, and I'll defer to them on how that might shake out. But on the wording side, I think it's difficult, and the role of the regulators. I know Neil, you might have some comments on this as well. May not be that big in the U.S. at least.
Yeah, Neil, if you do have something to add to what Judy said, that would be great.
Yeah, I mean, I think just to echo what Judy started her point off with, the inconsistency from a wording standpoint has also translated into inconsistency from an underwriting standpoint. So obviously, I think we would like to see some standardization, but obviously, I think cyber, given its novelty, both as a product and just as an overall risk that you're analyzing, I don't think we as brokers have enough leg to stand on right now to say every carrier needs to be underwriting to the same criteria, and we can't have it any other way. I had a market just recently tell me that they're now underwriting to exposure to mass arbitration demands in the event of a data breach and any kind of privacy litigation that arises from it. So I think that inconsistency definitely makes it difficult on us when we have larger clients that are looking for a more bespoke insurance product, some more bespoke language, and we have these varying requirements from different markets on the tower, varying guidelines, varying requests from an application standpoint. And I think we would like to see that develop over the next year. I think last year was more of a focus on controls, making sure those baseline table stakes controls were in place for the majority of the risks that are being presented to the markets. But now that that has, I think, been mostly accomplished, I think we need to transition more into trying to figure out what those key areas outside of those main controls are going to be. What are we going to be able to convey to our clients month to month as being the most critical areas? Obviously, we can't control things like metapixel litigation. Those things are probably going to continue to arise. There are going to be questions that come with it. But to create some more consistency, I think will really be beneficial to the market, because right now I think that inconsistent underwriting is also leading to vastly different pricing. And it's hard for us to present one quote to a client that is for 300,000, and then you have another market quoting that same risk for 80,000 with really no rhyme or reason to how they're arriving at those prices. No way for us to educate our client and why there is such a vast discrepancy. And I think, some markets are still maybe trying to stay where they were in 2022, and currently the market doesn't justify that. But I don't think we're going to have a sustainable and consistent product until we see a little bit more standardization across the board, not only from a market standpoint, from a broker standpoint. I think we can do a better job of getting the information that the markets need ahead of time so that we're not dealing with follow-ups. We've seen subjectivities go down substantially in the last 3 to 6 months, so that's been a positive development for us. But I do think that type of standardization will be critical to the product moving forward.
Yosha, just before I move on to my next question that I'd originally planned to ask you, what's your thoughts on what Neil has said about the inconsistency of underwriting? What's your take on that?
Yeah, I actually completely agree. I wish I could be adversarial here, Neil, and we could get into a nice debate. But I completely agree with everything he has said, and I think that while it can be frustrating for us and frustrating for the brokers, people it's the most frustrating for is the clients. And I hear time and time again from clients is that they don't really understand what the policy covers, what it doesn't cover. They don't really think the products that are out there are fit for purpose. And it's not always that they think that the coverage should be expanded. Every time I hear that, I always think, oh, they want us to, start picking up bodily injury or something. It's more that they, as Neil alluded to, they almost want bespoke policies that really address the needs of their particular organization and their concerns. But from our end, going through that and creating a bespoke policy for every single one of our clients would be quite onerous and would not really be sustainable in the market. So we've got to come to some happy medium in there. And I think that collaboration, the collaboration between underwriters and the communication right now is absolutely essential. While we're in a different situation, maybe than we were in a year ago, where we all knew that the rates were going to be going up and we were looking at re-underwriting, everyone was re-underwriting their portfolios. I still think we can't lose sight of that communication and having that really tight communication with our brokers saying, This is what we're seeing. This is what we're hearing from the reinsurers. This is what's going on from the regulators. You know, these are the requirements we're being asked to comply with when it comes to specific wordings. You know, this is what's going on from the government perspective and law enforcement. And then that allows the brokers to have a lot easier conversation with their clients when they have that toolbox in their back pocket of all the things that they know are actually going on in the industry. So, you know, communication and helping our customers understand what's within the four walls of the policy is going to be a huge thing I foresee in the next couple of years, and really helping fuel and grow this market.
And Yosha, you talked a little bit earlier about the need for better data. I think it's pretty clear from what Neil has said, there's a need for more transparency and consistency. And we've also talked a bit about systemic risk at the beginning as well. I'm wondering whether you could shed some light on how close you think the cyber insurance industry is, to getting a handle on systemic risk. And do you think that this will unlock new capital, or is the Beazley bond, for example, just a one-off for the industry?
Yeah, I think we're further along than we actually think we are sometimes when it comes to data and being able to do some deep dives into some of these systemic risks. You know, there's been a huge push, I would say, in the last 2 to 3 years. It's been especially driven from the reinsurance side, but I think it's also been driven internally from insurance companies, you know, management and their CISOs and their chief underwriting officers, and saying, show me how you can underwrite this profitably. Show me why you're making these decisions and why these are the right decisions in shaping the portfolio. And as a result of that, people have had to go back and start to really, really dive into the data on their portfolios and really start collecting things in a much more structured way. And so we are further along than we were 2 years ago, which it's moving in the right direction. I'm really happy to see that. And I think we can start taking it a step forward, even further. You know, we talk about the structured and unstructured data. And just for example, you know, in my particular portfolio, we write a lot of large accounts, and we have meetings with probably 70% of our insureds. You know, usually video meetings, the underwriter has the opportunity to ask questions and they take notes. And, you know, most companies that I've worked at in the past, when we take these notes, they go into a file, and you have this absolutely, you know, vast array of information on any one client, on, you know, how they're doing their backups, how they're doing their endpoint monitoring, what types of technology they are really reliant on for their companies to be up and running. And we're collecting that information. We're just not doing anything with it. And the conversations I'm having now, a lot of companies are starting to look at that and say, okay, we can structure this data. We can start to pull this out and start to really put all the pieces together and look at what a large scale event would actually mean for our portfolio and beyond, and for the market in general. And then I think the other part that's really important, which was also both Judy and Neil and Anthony might have mentioned this as well, was really around the consistency in some of the wordings. And in particular, the two I think that are really important right now are the war exclusion and the infrastructure exclusion. And while we're all sick of talking about the war exclusion, you know, this is a very real thing right now. And the more consistent that we can all get as an industry around this exclusionary wording, and being able to then communicate to our clients, this is what is intended to be excluded, and this is why this is intended to be excluded, and create that understanding from the client basis, it makes the brokers' jobs easier, it makes the underwriters' jobs easier, it makes the claim handlers' jobs easier, and they're all going to know really what the intent is from day one that the industry is really looking at covering. And that's going to help us also communicate how we as an industry are looking to control that type of systemic risk. So, you know, I'm continuing to lobby and push for a little bit more consistency in some of those wordings. Lloyd's has sent out guidance that we're to comply with by the end of March. I think that's really driving the conversation even further and starting to say we need to come to a landing page on this and make a decision about what we are and what are not covering. And then if a systemic risks happens that is still within the four walls of the policy, that's still intended on being covered, as long as it isn't triggered this or this, you know, and that understanding is really going to help customers come together. So I think that collaboration is really important. You know, I do think one of the things Neil also brought up that I think is really important right now is the distinction in an insured's particular investment in their own cybersecurity. And that's something that we have not been good at as an industry in the past, where we haven't really acknowledge the fact that somebody maybe really invested in their cybersecurity and really spent time and money to prevent these types of things from happening. And what we saw maybe 5 or 6 years ago was like, maybe they would get, a little bit less of a premium than somebody who really didn't invest in that. And that was not sending the right message. So I do feel like there's been a huge shift in sending that message and saying, we want you to invest in yourself and we're going to reward you for that by, giving you preferred terms, giving you preferred pricing as a result of you actually investing in these controls. And that distinction needs to become greater, and it's going to push the market then to invest more in controls, because that's ultimately going to be the only way that they can get insurance. So I think those are really important. I think, also Anthony alluded to handling some of these systemic events and really the ability from the incident response side to respond quickly and minimize the event and somewhat contain it on that side. And that's another area that, I think we all need to continuously invest in that side of the communication as well. So the incident response firms are learning from each other, talking to each other, learning how to get these under controls, working with law enforcement. We've already seen this. We already know what it looks like. We already know how to attack it. That's better for the industry overall. So as far as raising new capital, definitely needed. I don't think that's a one-off. I think everyone's going to be seeing ILSs in the headlines in the next year. It's going to be the thing that we're looking at, but they're not going to invest in it unless it's sustainable and a little bit less volatile than it's been the last couple of years, and that we have the data to support the decisions we're actually making.
Thank you. I'm going to shift the focus, circle back to Anthony, but I'm going to shift actually the focus to a different topic. I just want to look with you, Anthony, and then later Judy, at the trends that we've seen over the past year and what you think we're going to be taking forwards with us. So Anthony, just starting with you, which incidents did you see higher frequencies and severities over 2022? And how do you think underwriters should be taking that into consideration in 2023? And also, I think it would be really interesting to hear if you have a perspective on this, on whether the Russian-Ukrainian war has had an impact on that this year.
Yeah, absolutely. So I think, the last, few years, probably the overall, basic threats that people are seeing has probably been relatively static. If you go back further, the type of data breaches we were seeing 10 years ago are probably much less common nowadays. You still do see every now and then a website get compromised and, they're trying to steal financial data for credit card fraud and this sort of thing. But I would say, other than maybe the US specific W-2 fraud, which is actually fairly common, probably globally, I would look at two primary areas. Which are, one is ransomware and the other one is business email compromise. Obviously everybody, talks a lot about ransomware and the kind of losses associated with that. It's the business interruption, it's the recovery costs and the ransom payments. And then, on the business email compromise side, the largest loss you're usually facing there is if somebody actually is able to steal money, because that is, generally their intent. Although you may see other, in both those case types, you may see a lot of losses associated with data mining and notification costs and sort of class actions and all the sort of traditional, 10 years ago privacy stuff. So yeah, I think just kind of broadly, that's really what we're seeing. 2022 is interesting, and I do think it is in at least large part due to the Russian escalation of the war against Ukraine. That there has been, and again, I think it's coming into picture now, but there was a lot of kind of back and forth on this over the year. I do think ransomware has declined, at least in terms of the financial impact it's had. There are still lots of ransomware cases going on, but I think, sort of that being the primary sort of risk for insurers has probably declined at least a little bit. I do think it is in large part because, the sort of actors in the combat zone are busy doing other things, whether it's sort of cyber teams supporting their military or, perhaps they're actually being deployed. I don't know. But either way, I do think that the data correlates well to kind of see the slowdown happening at that time. So yeah, I think there's other things that might have had an impact as well. Tighter underwriting standards, as we've been talking about here, it must have had some impact. I think it's a little bit less clear, just because the correlation is there with the war. But I do believe it's had an impact. I think insurers, as Yosha was talking about, insurers charging quite a bit less based on controls, and just the conversation we've had around not having those controls means you may struggle to get insurance, or you may pay a lot for it. I think has made a difference. I do think kind of transitioning from last year, what does that look like? Sorry, one more thing I want to add before I go off that. Law enforcement activity is probably the other point. So I always think of those three things as probably the major ones. There has been a lot of law enforcement activity around taking down the larger ransomware groups, at least, which translates into kind of a additional ransomware as a service, smaller groups, people kind of trying to be a little bit more under the radar, these different cybercrime groups. And so I think that was probably the third major reason. Now, kind of leaving that point, probably another point I like to make on that, 2019, 2020, 2021 was a bit unprecedented in terms of the shift we've seen in terms of the companies that were at threat, as well as the scale. And then we had a pandemic on top of it. So I do feel like it was always going to stabilize, whether or not the war happened. Obviously the war is there, the war has escalated. But it wasn't going to continue, I think is my feeling on that. So yeah, the last couple of months we've seen, at least anecdotally, either in the press or things that are coming into us, we are seeing ransomware pick up a little bit. But if I'm an underwriter this year, I think I would probably broadly expect more of the same, at least until the war ends. But I don't think it's going to be 2020 again. I just don't see it happening. It's, we'll see, lots of things can happen. A big vulnerability could come out, maybe something, something else happens, but at where I'm sitting today, I don't see it. I think this year, business email compromise is going to, I think in 2022 is probably the largest in terms of volume. I think in 2023, if I'm an underwriter, I really want to look at that, especially if I'm writing crime, because again, that's going to be where a lot of the loss is. So, the multi-factor authentication, I think these days I generally consider a minimum. Sometimes companies will deploy it and they'll miss a few systems or whatever, miss a few accounts if we're on 365. But that's really a baseline these days. And I think we are seeing more and more sophisticated attacks. There's MFA fatigue, there's stealing session information, and those do exist and they do happen. But even today, it's so easy to compromise somebody through a phishing email. If you're just looking for anyone you can get, there's still a long way to go before we get to the hard stuff, before we get to the sort of more complex security topics. And so, that's really what I would be looking at as an underwriter. I know Judy had some points.
Yeah,
on that
I
as
was
well.
about to ask Judy, how does what Anthony said resonate with you, and what you've seen in terms of the types of claims you've seen, and the implications of that on coverages?
Sure. Yeah, I agree with everything that Anthony said. In my role as outside counsel to various insurers, I don't see a lot of the day-to-day claims. And so you should keep that in mind with how I respond to your question, because not every claim is going to end up on my desk. But what I've seen over the past year or so is a bit of a different dynamic with some claims. And I don't know whether it's driven by, higher premiums, higher retentions, greater potential exposure, things of that nature. But some claims just getting a little bit more contentious than they used to be. Anthony referred to the old data breach kinds of claims. Now where we have incidents leading to regulatory investigations, having operational impacts on the company's ability to do business, and ransom concerns. Some of the areas where I see kind of issues arising, and it's not always necessary in my view for these issues to arise, is around insureds either not following, not paying attention to certain policy requirements, things around consent, and providing notice, things of that nature. It could be a good opportunity for brokers to get more involved and try to make sure that their insureds understand what their policy requirements are around consent, around hiring approved vendors or people already on a panel, something along those lines. Some of the some of the claims I've seen that have gone most off the rails are when insureds go off panel, and sometimes they do that before the claim is even tendered to the insurance company, having already retained law firms and certain vendors, and manage the incident in a certain way that, in my experience, tends to really escalate the cost of the incident, meaning insurance coverage is potentially kind of burned dealing with things like that. I had a matter once where the insurer allowed the insured to go off panel, and the law firm had, I kid you not, dozens of lawyers every month working on the claim. Almost 30 lawyers every month were on the invoice. So things like that really shouldn't happen. We also have more challenges around getting information, particularly when you go off panel. Since the Capital One decision a few years ago, there's lots of assertions of attorney-client, work product, reasons not to provide information to the insurance company. I even had an incident recently where the vendor refused to provide information around the ransomware negotiation on the grounds that is proprietary to them. So all these things create real challenges in the claims process. I mentioned earlier issues around BI, communication, business interruption claims. Communication at the outset, I think, is really key to managing that. Making sure that insureds understand that there could be issues around internal costs, for example, continuing expenses, getting that out in the open early would surely help. Some other common issues that I'm seeing often arise around the payment of a ransom. Sometimes an insured will even have the key, or they'll have viable backups and still want to pay a ransom because of the suppression issue, the fear of a leak. Although we did see, according to some reports recently, only about 40% of ransomware claims were paid. Ransom was paid in about 40% of claims in some recent reporting that I saw from 2022. So, these are the types of issues that I'm seeing now. It's incumbent, I believe, on the brokers to try to make sure that the insured understands their policy requirements. It's incumbent on the insurers to, I believe, set up some procedures and processes around the use of off-panel law firms, off-panel vendors. Set your expectations around reporting and information to be shared, staffing, and budgeting. How to even little things like how do you submit your bills? At submitting your bills at panel rates, can make a big difference in the life of a claims person who doesn't have to do all that math. So just thinking about those things in advance. And because of the evolving nature of cyber claims, as I mentioned earlier, they can start out as a breach incident and then evolve into third party and regulatory and all these other things. Reserving your rights, acknowledging the claim early on, as early as you can, reserving your rights, updating your reservations of rights as the claim is evolving, and continuing to communicate with the insured and let them know your expectations on communication from them, I think would be really helpful.
Thank you. I think we're nearing the end, and I'm very conscious we've had loads of questions coming in. One more question, quick fire to everyone, all of the panelists today. One action that every audience member should do tomorrow to make 2023 the year of their career. let's start at the bottom this time and go to Judy and work our way back up the supply chain.
I would say stay current on the evolving risk landscape. And if you're a lawyer, stay current on how courts are looking at policy language and the regs, of course.
Anthony?
Every audience member, that's a tricky one. I'd say, you know, I've been thinking a lot around, you know, people just kind of maybe being determined to be open-minded and doing a lot of research into this. I think there's, you know, you can start to feel that maybe you kind of know it all, but things are changing so quickly. I could say lots of examples on the response side that I like, but that's probably my advice to people.
Okay, and Neil?
The easy answer is sign up for the Cyber Insurance Academy, everybody.
Hey.
I would say you pick the brains of people like Anthony, the DFIR vendors out there, because they have their pulse on what's going on day to day better than anybody, and they are what really drives the market overall, because obviously the more claims, the more difficult the market is going to be. And then read as much as you can about, you know, just cyber, the threat landscape generally. There's a few good books that have come out in the last year that I think are very, very educational and helpful. And I'm not going to plug them, but you can look on Amazon. They're just very, very helpful in knowing what the landscape is like, why the market is where it is, and educating yourself on, you know, what's to come, because this is going to continue to be a very fluid product and difficult landscape as we move ahead.
Thank you, and thanks for the shout out. Yosha?
Yeah, similar to the others, you know, continuous learning, keep learning about what's going on in the world. I was telling somebody the other day, not only do we have to be policy wording experts, but we also have to be regulatory experts, law enforcement experts, technology professionals, and now political risk experts. So, you know, there is no shortage of ways to continue to educate yourself in everything cyber. And the other thing I would also say is, you know, lean in toward to technology and innovation. I think especially, you know, in the insurance world, we tend to continue to do things the way we've always done them. And I think there's a lot of ways that we can push and stretch things and get better by utilizing technology.
Okay, thank you everyone for a really insightful discussion. We started at both ends of the chain looking at systemic risk, and then we moved on to consider how all these changes are affecting brokers, with a particular focus on challenges with communication along the cyber policy supply chain. Ended with a discussion about capacity, attack methods, litigation trends for 2023. And we're now going to move on to a very quick Q&A because I'm aware of the time. I would just like to, before we do launch the Q&A session, just want to launch this poll for our audience to fill in. It's just 4 questions to click through, with the last question being about what topics you want to see, what topics you want to learn about over the next year. The feedback is really invaluable, helps us to understand where we need to improve and what we can be offering in our continuing education program. So we really do appreciate it. And thank you. I'll leave the poll running, and you guys can answer it. The audience can answer it as we're going through the Q&A session as well. So thank you very much. Okay, let's get the Q&A questions up. I'm going to go with the James Venezia question. First, it appears that writing small and small mid-market accounts is an important way to distribute risk. Can you comment? Does anyone want to answer that one? I've got a burning desire to answer that one.
I'll take it first. You know, I think that's where there is the most growth potential in the market right now, is in that small mid-size account space. The one thing I always caution people, just because they're a small business or mid-sized business does not insulate them from claims. If anything, we've seen an uptick recently in claims activity in that space, and they tend to not always have the best controls in place. So I do think that there's real opportunity in this space for growth in the market. And I think by leading with a service forward product where you're helping them actually get their controls up to speed is probably the best way to do that.
Does anyone else want to provide a comment before we move on to another question? Okay. So an anonymous attendee has said, I'm in the cybersecurity industry. What is the general position of the cyber insurance industry on emerging tech like AI and GPT? Anyone? Anthony.
I can maybe slightly take that. Just one small piece of it. I'd say there's a potential for increased automation of investigations and increased automation of data breach response. So I'm separating those two: investigation, figuring out, how did somebody get in the system, what happened, et cetera. And then the data breach response component, I'm referring to doing like data breach reviews, basically. And there's a lot going on in terms of automating bits of that process, which should have a pretty good impact from an economic perspective.
Sorry, I was on mute. Neil, did I see you typing an answer to a question that maybe would be beneficial to the audience? Am I imagining that? You're on mute. You're muted.
Sorry, yeah, I responded to one general question about BDCs and the fact that they are covered under cyber policy generally, but I was typing a response to the question about silent cyber and technology companies. I think that's been a very interesting point of discussion for us as brokers, because we do have a lot of manufacturing clients that are, there is exposure for resultant property damage or maybe bodily injury that is the result of a cyber event. We haven't seen any claims that have arisen for that, but obviously those types of things would be excluded under both a property and a cyber policy. So they are generally things that we are trying to get out ahead of. There are some standalone products that cover resultant property damage from a cyber event, including one that we write through locked in through a partner with Lloyd's. So it is an area that I think is still a little bit gray. It's hard to articulate to manufacturing clients or give them a sense of what that exposure may or may not look like, which is one of the big reasons why generally they go bare on that coverage. But it is something I think we will see continue to develop. And obviously silent cyber is something that we are constantly thinking about, when it comes to those that have an OT environment, those that may be at risk of having that kind of exposure or damage in the event of cyber attack. I just think that's something that's still developing. Yosha might have more on that.
Yeah, I'm just going to agree with you right now. And in the interest of time, we can have another conversation.
I just want one more question to get in. From Gabrielle Wong, is there a general approach or common practices adopted by practitioners in the handling of a cyber claim for small and medium enterprises? Judy and Anthony, I'll let you fight over which one maybe should be answering that question.
I'll let Anthony go first if that's okay, because I think the IR part is probably the most urgent in those situations.
Yeah, sorry, I'm trying to find the question again. Could you repeat it? I was looking for it.
Is there a general approach or common practices adopted by practitioners in the handling of a cyber claim for small and medium-sized enterprises?
I'm not precisely sure how to answer that, but I think it's probably the most important thing for me is just having control of the claim. So if I'm on the insurer side, just really having an understanding what's going on, making sure that the vendors are appointed, are qualified, are, aware of how to work with insurers, understand, kind of how the whole ecosystem works. I think that's probably the key thing for me.
Okay, and Judy, if you want to share just before I close off the webinar.
No, I agree with that as well, and that goes back to the prior comments about the insurer really probably wanting to maintain a lot of control, right? When you're writing in that space with probably unexperienced companies, and managing the event efficiently and effectively is really key.
Yeah, I think one thing, let me circle back again and just add to that. It is really it's really the case that insurers, the ones who write a lot of cyber, write a lot of primary cyber in particular, are very, very experienced at dealing with cyber incidents. And so it's not just a situation where me as a client has to think of the insurer as being someone who's fighting against me. In general, the interests are going to be very well aligned, and working with your insurer almost always is going to result in a better outcome because they've dealt with so many incidents. And I think the key thing you remember is they're paying. So they see the economic impact of different decisions and different ways of handling things. So just wanted to
Okay,
add to
I
what
think
Judy
that's
said.
a wrap, but thank you very much for sharing all of your insights. They are truly gold dust, and I'm sure that the audience agrees. If you aren't following us on social media, please do. We post all about our events and continuing education opportunities there. And I think that's everything for today. But thank you very much, everybody.
Thank you.
Bye-bye.